Hello, everybody. Hello, hello. I think everybody's mute. So if you want to
Hi, good
say
morning.
hello, hello,
Hi.
hello. Hi, Don. Hello, Claudia.
Hi,
Hello,
good
Gina,
morning.
Bill. Hello, everybody. Let me just make some of my Kara, I'm gonna make you my co-host so you can help me admin people in the room. I see Larissa here. Let me make her the co-host as well, Larissa. I think we're good. Okay, Carol and Larissa should be good. Please help out meeting people. In the meantime, I'm gonna go live on Facebook. And let me go live first. Hi, Don. Hi, Erik.
Hi, Lindsay,
Thank
how
you
are you?
for being here. Good. Good.
Good.
Thank you.
Hey,
And you?
Lindsay, you need to promote me to host at some point so I can share the PowerPoint.
Yeah, I'm gonna give you the rights to share a screen now, right?
Okay.
You have the rights to share. We're not gonna have the mortgage minute today. Unfortunately, Randy cannot join us today, so we're gonna go right into your presentation, Don and Erik. But first, let me just okay. So Gogo is not here, guys, because she's on a cruise. She's enjoying her week on a cruise with her family. Um, so she won't be able to join us, but we have Don and Erik who are the guests today. And I'm gonna go live on Facebook now. So we have our team Google watch from there as well. And I think we can go and get this started so we can honor everybody's time here because you are on time. So thank you so much. Let me just put it live very quick. Let's see. And guys, feel free to unmute yourself and ask questions. I know Don and Erik are awesome, so they will be helping us with anything that we need. Go training. Let me see, where are you? Team Google. I have so many Facebook groups now. Okay, I think we can get this started. Don and Erik, feel free to, the floor is yours. You have the rights to share your screen. I'm gonna help you on the chat as well. If there's something that I know the answer, I can chat, but if not, I'm gonna maybe ask you, I'm gonna unmute myself and I'm gonna ask in others' behalf. But guys, feel free to unmute yourself and ask questions as well. I think it's nice if we ask the questions as we are on the topic, So yes, I think, can you guys see me? Am I good? And can you guys hear me as well?
Yeah, we can see and hear you.
Yes? Okay, awesome. Okay, yeah, let's get it started.
Oh, hold on, Don. I think you're on mute, Don.
How's that?
Now we can hear you.
All right, all right. And Lindsay, if you could add Rhett Gagan to the chat as well, because he's going to answer some questions for us also.
Sorry, who then?
Rhett Gagan, RHETT-GAGON.
R-A, we don't have...
Gagan, Gagon, RHETT, Rhett?
No, we don't. No.
Okay. All right.
Yeah.
That's okay.
Oh, yeah, the list.
That's okay. We're good. All right.
Okay.
Good afternoon, everyone. My name is Dawn LaVanway, and I'm an account executive at Cost Segregation Authority. As Lindsay mentioned, GoGo is enjoying some time with her family on a cruise. So she invited Erik Oliver and myself to the call today to talk about a couple of tax saving tools that she has recently used and taken advantage of with our company on her personal rental properties. She was pretty excited about her tax savings results this year, which we are going to go over in the presentation today. And she just wanted to ensure that you all had an opportunity to learn more about these tools for yourself personally or to help your clients. Some of you may be like I was about a year ago, and unfamiliar with cost segregation. And some of you may have heard of 45L and cost segregation. So we're here today to talk about these tax saving opportunities, to go over the recent changes and how to help you and your clients take advantage of these tax deductions. So I'm going to let Erik introduce himself, but he is our resident expert and the VP of our channel partnerships. So Erik, I know you have a lot of information to cover, but maybe let's start off with you telling us a little bit about your background and your role here at Cost Segregation Authority.
Yeah, thanks, Don. Thanks, Lindsay, as well. So as Don mentioned, my name's Erik Oliver. I'm with Cost Segregation Authority. Been doing this for about 7 years now. Honestly, didn't know what cost segregation was when I applied for the job. I, like many people, had heard the term. My degree's in accounting, and so numbers have always come somewhat easy. So I was looking for a job where I could use my degree. Came across this, had been investing in some real estate, and haven't turned back ever since. So that's a little bit about me. About the company, we've been doing cost segregation for about just over almost 20 years now. We've done 25,000 studies in all 50 states. Our reports are very easy to read. They were designed by CPAs for CPAs, which tax preparers love that because these can get quite complicated. I've seen reports that are anywhere from 100 to 200 pages long, and ours is about 40 to 50 pages. So it really is concise for your tax preparer. But with that, we'll go ahead and jump in. That was just a little history on the company. Just wanted to let you guys know that we've been around for a while. We're kind of a niche accounting firm. This is all we do is these energy credits and these cost segregation studies. So we don't actually do tax returns at our firm, but rather we partner with your tax preparer, your CPA, to be able to offer some of these deductions that we'll talk about today. As Don mentioned, there's really two things we're going to talk about. The first thing is 45L. I would imagine most of you probably haven't heard of 45L. It's probably one of the most underutilized real estate credits that I'm aware of. 45L is for the construction of energy efficient residential units. So we'll talk about who qualifies, how you qualify, what that credit can look like. And then we'll jump into cost segregation. I imagine some of you have probably heard the term cost segregation. Maybe you're familiar. Maybe you've even done cost segregation on your own rental properties, or you've had clients who have done cost segregation. But we'll go a little bit deeper dive today. We'll talk about what it is and then some of the extra benefits of cost segregation. So that's the agenda today. As we mentioned earlier, as Lindsay mentioned earlier, please feel free to unmute yourself. If you guys have questions throughout the presentation, don't hesitate to interrupt. I'm happy to answer questions as we go. And so please, again, just make sure you unmute yourself so that we can hear you if you have any questions. All right, so with that, let's jump into the 45L. So 45L, as I mentioned, it was part of the Inflation Reduction Act of a couple years ago. Honestly, 45L had been around prior to the Inflation Reduction Act, but with the Inflation Reduction Act, it made the 45L, extended it through 2032. So part of the reason I think the 45L goes underutilized is the IRS would allow this to expire at the end of every year. And then Congress would get together and they'd be like, well, that was a good program. The Democrats like the green energy, the Republicans like the tax credits. They're like, hey, let's do that again. So then they would pass the bill again, extend it for that year, but it was always retroactive. And so I think tax preparers just never knew if this was on or off. Again, with the Inflation Reduction Act, it has been made permanent. Now, permanent, according to the IRS, means what? I guess it means until they change their mind or until we get a new administration, but currently it's permanent. And so what is it? Again, it's a credit for the construction of energy efficient residential units. So if you or your clients are building residential units, anything from an ADU to fourplex, single family homes, apartment buildings, anywhere where somebody lives. Now, the IRS has their definition of a dwelling unit. A dwelling unit, according to the IRS, has to have 4 components. It has to have a place to eat, a place to sleep, a place to prepare food, and a place to use the restroom. And if your unit meets those qualifications and it was built using energy efficient materials, it may qualify for anywhere from a $500 credit all the way up to a $5,000 credit. Now, remember, credits come right off the top of your tax bill. These are dollar for dollar tax credits that come right off your total tax bill when you have to pay your taxes. So with the 45L program, you can go back as far as 3 years. You do have to amend your return. So let's say I built a home in 2022 and I've already filed my 2022 taxes. If my unit qualifies, I may be able to go back and claim that $5,000. Well, in that case, actually, it would be a $2,500 credit because it was built in 2022. So you can see here, anything built between 2006 and 2022 was eligible for $1,000 to $2,500, and then 2023 to 2032, it's $500 to $5,000. So it depends on when your building went into service on how much you're eligible for. We are looking at really 3 main components when we look at for the 45L. We're looking at the building envelope. That's the exterior walls of the building, the insulation in those exterior walls, the windows on those exterior walls, the insulation in the attic. That's the building envelope. We're looking at that. We're looking at the heating and air components. So whether we're looking at how efficient is the heating and air units in those buildings. And then we're also looking at the lighting. Those are kind of the 3 big components. There's a whole number of things that go into whether or not your units may qualify, but those are the 3 big components that we're looking at to see if your units qualify. Now, people will say, well, if I buy a brand new residential home, am I eligible for this credit? And the answer is no. It's whoever has basis in the property at the time of construction. And so what does that mean? In order to have basis at the time of construction, if I'm a developer and I build a 4-plex, for example, and then once it's done, I sell that 4-plex, excuse me, I sell that off to an investor. Because I had the construction loan, I'm the one, I always think of it as who's deciding what quality of windows and insulation to put in the building, and it's usually the person paying for it. So because I took out the loan, I decided what windows and insulation, therefore I'm eligible for this credit, even though I sold it off to an investor. So just keep that in mind as you're talking to your clients. If they are building new properties and they're carrying the construction loan, they may be eligible for this credit. So in contrary, let's say I'm an investor and I hire Don as my contractor and say, hey, Don, I just took out a loan for $1 million. I want you to go build me 2 4-plexes. Then I would be the one as the investor that's eligible for that credit because I'm the one that took out the construction loan. So just keep that in mind as you're talking to your clients.
Can I ask a question?
Yes, please.
Does it also apply to, say you have a fixer-upper that you purchased and you're going to be redoing that fixer?
Great question. The answer is yes, it may apply. Now, with improvements or remodels to qualify for the 45L, you basically have to take it down to the studs. And the reason for that is because oftentimes when we remodel units, we may just go in and put in some new carpets, some new appliances. Maybe we do put in heating and air, but rarely do we go in and replace the insulation in the walls and replace the windows. But if you do, I have seen remodels where they take it down to the studs, they put in new insulation, they're putting in new windows. Maybe they're converting a hotel into condos or something along those lines. In that case, it would or it may qualify for that credit. Now, one thing I failed to mention is that you do have to have a third party come in and qualify your units. So this isn't something that we can qualify individually. It is something we do here at Cost Seg Authority, but you yourself can't qualify your units individually. You have to have somebody who's ResNet certified to be able to run the modeling to determine how energy efficient your units are. So that was a long answer to your question, but the answer is maybe, but typically you're going to have to take it down to the studs in order for it to qualify for this credit. So here's a quick example. This was a 50 qualified units. This was a home builder. They built 50 units. Had those units got into service in 2022, they would have received a $2,000 credit. So a total of $100,000 tax credit. But these units actually went into service in 2023, and you can see there was a significant jump in the value of those credits for 2023. It went all the way up to 5,000. And actually, it's a little bit higher than that because they actually adjust these credits for inflation. So because we had inflation this year, I think it's at 565. So, but you can see the drastic difference there. Again, I can't tell you how many times we've presented this to home builders, investors across the country who are building hundreds of units every year. They've never heard of this, never taken advantage of it, and we were able to go back and claim these massive credits. Now, keep in mind, these credits are non-refundable, meaning if I got a $250,000 credit, but I only owe $80,000 in tax, I would wipe out my $80,000 tax bill, and the remaining $170,000 of credit just carries forward until I utilize that whole credit, but I don't get a refund check for that credit. So just keep that in mind. Couple questions. One, we've already answered here. That was a great question. Can a remodeling project qualify? The answer is, as I said, maybe, depending on how extensive the renovations is, but usually you have to take it down to the studs. Can I apply for this tax credit for past properties? As I mentioned, the answer is yes, but remember, you can only go back 3 years because you do have to amend your return. So you can go back 3 years through the amendment window and take advantage of this. And then is there a maximum number of units I can claim? And the answer is no. So again, if you've claimed, or if you've built, 100 units over the last couple of years, you can claim all of those. There's no maximum credit that can be claimed. So we did add a QR code here for those of you who've got properties who you think might qualify. If you scan that QR code, it'll take you to GoGo's link. Once you put in your information, it'll forward that information over to us. And then we can run an analysis. We always want to look at the properties before we ever engage somebody to do this certification to make sure they're going to qualify. The good news is if for some reason they don't qualify, you won't be charged anything. So these 45L certifications are usually around $300 to $400 per door. So depending on how many doors, that number may come down slightly, but usually around $300 to $400 per door to get the certification done. But again, if it's going to save you $5,000 in taxes, oftentimes that's well worth it. So any questions? I see I've got a couple here in the chat. Let me, oh, it looks like they just added the QR code in the chat, so that's perfect. So any other questions before we move on? All right. All right, so let's talk now about cost segregation. Like I said, many of you have probably heard the term cost segregation, but maybe don't fully understand what it is. Cost segregation is really just accelerated depreciation on your real estate assets. So one of the benefits of owning real estate is the ability to take these depreciation expenses against your income. Now, normally residential units, anywhere where somebody lives, are depreciated over 27 and a half years. Commercial units are depreciated over 39 years. So let's make the math easy. Let's say I buy a $275,000 home. You take that, you divide it by 27 and a half years. Essentially, you're getting a $10,000 write-off every year for the next 27 and a half years. Now, I've oversimplified that just to make the math work, but you do have to back out the land value. Just keep that in mind. Land is non-depreciable. So you take your purchase price minus your land value, and that's what we call your depreciable basis. And that depreciable basis gets divided up over, in that case, 27 and a half years. So remember, that's a deduction. It acts as an expense, and it comes off my taxable income. So in that example, let's say I make $110,000 a year. Instead of me paying tax on $110,000, I'm now only paying tax on $100,000 because I've got this $10,000 depreciation expense, which again is great. That's why a lot of us get into real estate. The problem that I see with that is I'm not going to own my real estate for 27 and a half years. I typically buy it for 5 to 7 years and then sell it. Even if I am going to hold it for 27 and a half years, I want my deductions now versus taking 1/27th of those deductions for the next 27 and a half years. There's a number of reasons why I want my deductions now. I want it. Inflation is a big topic right now. $1 today is worth way more than $1 27 and a half years from now, right? There's time value of money. I want to put my money to work. I want to have that tax savings today so that I can go reinvest it in another property. Or I want to pay down my debt, with interest rates the way they are. So there's a number of reasons why you would want your money today versus in the future. And cost segregation allows us to do that. Now, the way we're able to do that is when you bought that single family home for $270,000, you're not just buying the land and the walls, you're also buying the carpet, for example. You're buying the ceiling fans, you're buying the window coverings, you're buying the driveway, the parking lot, the curbs, the gutters. All those things I mentioned should be depreciated over a much faster useful life than 27 and a half years, according to the IRS. So for example, carpet is a 5-year asset. Carpet should be depreciated over 5 years. It certainly doesn't last 27 and a half years. The problem is if I'm your tax preparer and you buy a property, you then hand me the closing statement. All I know is that you bought 123 Main Street for $275,000. I have no clue that there's even carpet in the building, let alone what the carpet is valued at. And so with the cost segregation study, just as the name implies, we go into these assets and segregate the costs into different buckets, which allows us to depreciate it over a much faster useful life. So that's kind of cost segregation at a high level. Any questions on that? Again, it's just accelerated depreciation on your real estate assets. All right, so now let's talk about how we identify what can be segregated within a building. There's really 3 tests that the IRS has laid out that allows us to segregate or accelerate the depreciation on some of these assets. The first is if the property can be removed without damage to the building or structure. So if I take the carpet, I'm here in the office, if I take the carpet up here in this office, it's not going to damage the building or structure. If I remove this window covering behind me, it's not going to damage the building or structure. So that's usually a good indicator that that's a short-term asset. The second is if the relationship between the asset and equipment or machinery is so close they would be retired at the same time. So I'll give you an example in that single-family rental. Let's say the washer and dryer is a good example. So washer and dryer is a short-term asset. But not only is the washer and dryer a short-term asset, so is the electrical and the plumbing that goes to my laundry room. The only reason I have electrical and plumbing going to that laundry room is specific for that washer and dryer. And therefore, I can find a value of that electrical work all the way back to the circuit breaker, put a cost to that, and say that this electrical work is specific for this piece of appliance or these appliances, which allows me to segregate that electrical work over a shorter period of time. So if you think about a single family home or even a multifamily, how much of the electrical work that goes into a residential unit is specific for short-term assets? Things like garbage disposal, ceiling fans, washers, dryers, range hoods. Sometimes it can be as much as 50% of the electrical work going into a building is specific for those short-term assets, which means we are allowed to segregate it, put a value to it, and depreciate it over a much shorter useful life. And then the third is if the relationship between the asset and the nature of the business are unique. I'll give you an example. I don't know if anyone knows what mead is or a meadery that produces mead. I didn't know what it was at the time. We got a call to do a meadery down in Arizona, in Phoenix, Arizona. I had to look up what a meadery was, and I found out that mead is just fermented honey. So they take honey, they ferment it, and it makes an alcoholic beverage. So we go down to Arizona. Of course, it was in July when it's 120 degrees down there. We go down there in July, it's 120 degrees. We go into this warehouse. They have these 50-gallon drums of honey all throughout the warehouse. Well, that honey, if it gets hot, it's very difficult to work with because it becomes very runny. So they had this specialty cooling equipment. Really, it was just HVAC units that were keeping this honey at a certain temperature. Well, because that was unique to their business, we were able to segregate that as equipment and depreciate it over a much shorter useful life versus normal HVAC equipment that keeps you and I cool in a building, that gets depreciated over 27 and a half or 39 years. So there's some unique cases where we can go in and actually convert some of what would normally be a long-term asset like HVAC and convert it to a short-term asset such as equipment based on what it's being used for. So here's some commonly segregated items. Over here on the right-hand side, we have our 5 and 7 year assets. These are things like carpet, countertops, cabinets, window covering, parts of the lights, parts of the plumbing, window treatments, wall covering. Flooring is an interesting one. Depending on the type of flooring, it may be a short-term asset if it's LVP, for example, or carpet. But if it's natural wood or ceramic tile, that is a long-term asset. So again, it depends on the type of flooring. Here in the middle category, these are our land improvements, our 15-year assets, everything from parking lots, curbs, gutters, asphalt, storm drains, irrigation systems, retaining walls, trees, bushes, and shrubs. That's kind of an interesting one. When we're doing a cost segregation study on a single family rental, we'll actually go around the building and count all the trees, bushes, and shrubs because those are 15-year assets. We can put a value to those and depreciate them over 15 years versus 27 and a half. And then over here on the left, these are all of our long-term assets, things like the steel structure, the framing, the roofs, the walls, the doors, the sheetrock, windows, HVAC, all the structural components of your building. Now, when we do our cost segregation studies, we usually segregate around 30% of the building's purchase price, minus the land, into these short-term assets here. The other 70% stays in these long-term categories. But by moving 30% of that into 5, 7, or 15 years, we get to front load that, take that depreciation at a much faster rate, which creates a bigger write-off for us in those early years. Let me go to the next slide here. All right, so that's, again, cost segregation kind of at a high level. I've given you some ideas of what can be commonly segregated and how that works. So now let's talk about some of the additional benefits of doing cost segregation. So the first one is bonus depreciation. Some of you may have heard of bonus depreciation. Bonus depreciation has been around for a number of years. It's a tool that the government uses to stimulate the economy, but essentially it puts cost segregation on steroids. It creates massive deductions, and I'll walk through an example here in a moment of how that works. Then we'll talk about catch-up depreciation. Catch-up depreciation is the ability to do cost segregation on assets that have already been placed in service. So let's say you're sitting here today. This is the first time you've been introduced to cost segregation. You met with your tax preparer yesterday. They told you you owe a boatload of taxes for the 2023 tax year. You've got some real estate that you bought a few years ago. You can actually do cost segregation on that real estate you bought a few years ago. Bring all that missed depreciation forward, drop it on your 2023 tax return, and take those deductions and create a huge tax savings. And we'll talk about how that works. Reduction of recapture on sale. That's a question we get asked quite often is, Erik, when I sell my asset, if I take all this depreciation up front, that means that my capital gains when I sell it are going to be significantly higher and my recapture tax is going to be higher. Isn't it just a timing issue? Isn't it just a wash? If I take all these deductions now, I've got a bigger tax bill when I sell it, and it's just a wash. And I'll explain to you here why it's not. There's some rate arbitrage where you're taking your deduction at a high rate, paying it back at a lower rate at a future date, and saving that spread. And I'll give you an example of how that works. And then if we've got time, we'll talk about partial asset dispositions, what those are and how those apply. All right, so let's jump into bonus depreciation. As we call it in our office, you'll see we call it super bonus. I don't know that that's a technical term. Wouldn't look that up on the IRS's website, but basically it is super bonus. Bonus has been supercharged. So as I mentioned earlier, bonus has been around for a number of years. The IRS has used bonus to stimulate the economy. So when the economy is not doing well, they'll increase the bonus percentage. When economy is doing well, they'll decrease the bonus percentage. Let's back up to 2017. At the beginning of 2017, bonus depreciation was at 50%. It was on assets that had a useful life of 20 years or less, and they had to be brand new assets. So I'll give you an example. I buy a bulldozer, a brand new bulldozer at the beginning of 2017 for $1 million. I would be able to take $500,000 or 50% of that as a deduction in the first year. The other $500,000 or the other 50% would get spread out over the useful life of that bulldozer. Fast forward to the end of 2017, Donald Trump's our president. Donald Trump owns real estate, and Donald Trump revised the tax code. It was very favorable to real estate investors. A few things changed. One is they increased the bonus percentage from 50% to 100%. So as you can see over here on this chart to the right, any assets placed into service between 9/27 of 17 to 12/31 of 2022 were eligible for 100% bonus. You can see any assets bought last year in 2023 were eligible for 80%. This year it's 60%, and then it slowly phases out 20% every year until 2027 when it's down to zero. Now, that's the current tax law. There is a bill in Congress right now. It's actually passed the House. It's sitting with the Senate. They're trying to extend the 100% bonus through 2025. So we're watching that closely. Honestly, my opinion, because we're in an election year, I think the Senate is going to hold it up and probably not pass anything until after the election. But they are trying to extend the 100% bonus. So we'll have to watch and see if that gets extended. So let's talk about, so let me go back to that bulldozer example. So now if I buy a bulldozer in 2018, two things changed. One, it went from 50% bonus to 100% bonus. So now if I buy $1 million bulldozer, I get $1 million deduction, or 100% of that as a deduction in the first year. That was the first change, which is huge. Number two is they added 6 words. It's 5 or 6 words. I'm going to count them here in a moment, but they added 5 or 6 words to the tax code that made a huge difference. And I don't even think that the folks in Congress knew that these were added and knew what the impact would be, but they added the words "new" to "you, the taxpayer." So that's actually 6 words. So remember, I had to buy, in that old example, I had to buy a brand new bulldozer in order for it to be eligible for bonus. Now I can buy a used bulldozer. It's new to me, the taxpayer, and I'm eligible for 100% bonus. So enough about bulldozers. I don't know how many of us are selling bulldozers. Most of us are in real estate. So let's talk about how this applies to real estate. If I buy a used building, a building that was built in 1980, and I bought it in, let's call it 2018, I'm eligible for 100% bonus depreciation on all the assets in that building that have a useful life of 20 years or less. Now, we'll present this oftentimes to tax preparers, and they say, well, Erik, bonus depreciation doesn't apply to real estate investors because real estate, remember, gets depreciated over 27.5 years or 39 years. And in order to take advantage of bonus, you have to have assets with a useful life of 20 years or less. And I said, well, that is true. However, if you do a cost seg study, we go in and identify the 5, 7, and 15-year assets. All of a sudden, that 30%, if you remember, I mentioned we usually segregate around 30%, that 30% is now eligible for bonus. And so we're creating massive tax deductions. Let's just do some simple math. Let's say I buy a $300,000 home, residential unit. If we segregate 30% of that, that would be around $100,000. And if I now get 100% bonus depreciation on that, I get that full $100,000 deduction all in year 1, which means, again, I can reduce my taxable income by $100,000. So if I'm in a 37% tax bracket, that's a $37,000 tax savings when I bought that $300,000 home. So let's look, here's a case study. This is a home we did. We're going to actually look at some of Gogo's properties that she just completed with us. She actually completed 2 of them, and we'll talk about what those deductions look like. But we're going to go into these.
Hey, Erik, sorry.
Yeah.
I have a question in the chat from Beth.
Sure.
What if you receive a property through an estate? What if you receive a property through an estate?
Okay, so maybe like they inherit, I think what they're asking is if I inherit a property, maybe my father owns a property, he passed away, I inherit that property. It does get a step up in basis. However, when you inherit property, you are not eligible for bonus. So you get a step up to fair market value when you inherit that property, and you pay no tax. Nobody pays tax on that step up in basis. So what that means is, let's say my father bought it for $200,000 20 years ago. It's now worth $800,000. My father passes away. I inherit that property. When I put it on my depreciation schedule, or when I put it on my tax return, I get a value of 800,000, and I get to start depreciating that 800,000 over 27 and a half years. But you do a cost seg study, and now you get to depreciate a portion of that over 5 years, 7 years, and 15 years. You're just not eligible for bonus if you inherit a property. Good question. All right, so let's go back to this example here. We've got our cabinets, our countertops, we've got a retaining wall, we've got our electrical panels, we've got some flooring, some lights. Let's see what we were able to do. So this is a real life example. This property was purchased in 2023. The purchase price, what we call, remember the depreciable basis here. Let me get my pointer here. Our depreciable basis here is our purchase price minus land value. So we've determined that to be 179,000. Now, if I take this 179,000 and I divide it up over 27 and a half years, I'm essentially getting a $6,532 deduction every year for the next 27 and a half years. Now, this first year, you'll see that it was bought at the end of the year, so it's not a full year of ownership. But essentially, each full year, I'm getting a $6,500 write-off. That's without cost segregation. This green section here, this is with cost segregation. We still, across the bottom, we've got our $179,000 asset, but now we've broken that up into 5, 7, and 15-year assets. You'll see my 5-year assets, we determined there was $50,000 worth of 5-year assets, things like carpet, countertops, etc. There was no 7-year assets in this building, but there was $1,000 worth of 15-year assets. Not a huge amount here because this was a townhouse. So they didn't own a bunch of the outside stuff because it was a townhome. Usually we see about 10% here, but in this case, it was only 1% because it was a townhome. But the idea is, remember, this was bought in 2023. So we're eligible for 80% bonus. So we take this 50,000, we're going to get 80% of it in the first year. The other 20% spreads out over the next 4 years. Same thing with our 15-year assets. We're getting 80% in year 1, but look what it does over here to my new depreciation schedule. So in year 1, instead of getting a $1,000 write-off, I'm now getting a $42,000 write-off. Year 2, instead of getting a $6,000 write-off, I'm getting an $8,000 write-off. So in these first couple years, I'm increasing my depreciation by about $45,000. That's creating about a $17,000 tax savings. $41,000 of additional deduction times your tax bracket, that's about a $16,000 or $17,000 tax savings. Now you can see in year, 2026, I'm going to actually get $474 less of a deduction, but I'm okay with that because I've taken this $16,000 or $17,000 of tax savings. I paid down my debt. I went and put it down on a new property. I'm okay with taking a little bit less in the future. You'll see at the end of the day in either schedule, whether you don't do cost seg or you do cost seg, the end of the day, we're getting the same amount of deduction. It's just in this scenario, we're front loading that deduction in the early years. And so we've actually got another example. Let me turn the pointer off and I'll advance it here to the next example. This was a Florida condo. This one had a significantly higher purchase price. This was bought for $670,000. You'll see we don't have any 15-year assets here because it was a condo. So you don't own any of the parking lot. You don't own the part of the pool. Whoops, in this example, let me go back here, sorry.
Can we do this magic for me?
What's that? Oh, no, sorry. I thought you had a question. Sorry, Gina. So in this example, this was a condo. There's no 15-year assets, but look at the 5-year assets. We were able to find $159,000 worth of 5-year assets. We take 80% of that in year 1. That created $143,000 tax savings. You can see that here. $143,000 worth of depreciation, excuse me. You take that times your tax bracket, it was a $45,000 tax savings. Had you not done cost segregation on this asset, you would have got a $13,000 deduction we did cost seg, we got 143,000. That's an increase of $130,000 of depreciation, which is a tax savings again of $45,000. Now, these properties here are conservative in their results in the fact that there was no land owned in these. Remember, I said we usually segregate around 30%. You can see in this one, we actually segregated 24% because it was a condo. But if you think about a single family home where you own the fence, you own the driveway, the curbs, the grass, the irrigation, usually we'll see somewhere around 30 to 35% segregation, which means these numbers would be even greater. But you can see the value on this one. If we didn't do cost seg, we'd get a $24,000 write-off every year, again, for the next 27 and a half years. But by doing cost seg, we're front loading or taking these big deductions in the early years. Any questions on that? Hopefully you can see the value of one, cost segregation. Now let me just back up because I do want to say, if it weren't for bonus depreciation, we would take these 5-year assets, this 159,000, and we would spread it out a little more evenly. But because of bonus, it allows us to, again, take that 80% in the first year. So you can see why I say bonus depreciation puts cost segregation on steroids. It's still better to move part of this long-term 27.5-year bucket. It's still better to move it into a 5-year bucket, even if I have to take it over 5 years. But then when you add bonus and I get to take 80% of it in year one, again, we create these massive opportunities for tax savings. Looks
Hey,
like there
Eric,
might be a question. What's that?
Yeah, Eric, we have a question about recapture. So did you want to maybe address if there, they want to know if there's a penalty if you sell soon after doing the study?
Yes. So I'm going to actually hold tight on that question because I've got a slide here. I think it's not the next slide, but the one after that. So hold tight, but that's a great question. What happens when I sell this asset? Again, you're paying part of that back in the form of recapture and capital gains, and I'll talk about why in most cases it still makes sense to do that. So give me 1 second here because I just want to go to the next slide. I think,
Eric,
this,
Jocelyn also, I think Jocelyn has a question. Hi,
yeah,
Jocelyn.
Hi, yeah, I was just going to ask, so if you buy a property that needs renovated in order to be in the livable standard, so like a BRRRR method or something like that, then how do you handle that? Yeah, I don't know if you're going to be covering that already.
No, that's a great question. How are improvements handled? So best case scenario, if depending on the condition of the property, if you can somehow place it into service first, we want to do the cost segregation before the improvements are done. And now you can't do that in all situations. Sometimes you buy a house that's just beat up too badly. It's not livable. So you buy a vacant home, you fix it up, and then you put it on, you start renting it at that point. But if there's any way possible, let's say I buy a home that hasn't been updated in 20 years. When I buy it, there's still a tenant in there. Maybe their lease expires in 3 months. It goes into service the day I buy it because it's being used. In service means available for its intended use or purpose. So in order to start taking depreciation, your asset has to be available for its intended use or purpose. And if you've got somebody living there, then it certainly is available for its intended use or purpose. So best case scenario, you've got somebody living there. We do our cost segregation study before you do your improvements. That way we're going to fully depreciate the old carpet, the old countertops. We're going to take that deduction. Then when you go in and put in new carpet and new countertops, you then get to take depreciation on those new assets. So in that case, best case scenario, we're getting the old assets plus the new assets. We're creating a huge tax savings. If it's not in service, then what ends up happening is you buy a vacant building, you put your $60,000 of improvements into it, and now we do our cost seg study on the purchase price plus the improvements, all with one in-service date. So hopefully that answers your question. If there's any way possible to try and get it in service before you do your improvements, that creates the largest tax savings, but that's not always possible. Like I said, if you bought a house that was really beat up and you couldn't, it wasn't livable or it wasn't available for rent, you had to do your improvements first, then we would do the cost seg study after those improvements go in and include those as part of our study. So it looks like I'm going to look at the chat here. It looks like we've got a couple more questions. Let's see here. But what if I receive it through an estate sale? We answered that. If I purchase an investment single-family house with my husband in 2023, could I get more deductions on my taxes in 2023? That's a great question. So that's a timing question. The question is, if I bought a house, an investment property in 2023, can I still get those deductions on my 2023 return? The answer is yes. You don't have to have the cost seg study done in the given year, in the calendar year. You have to have it done before you file your 2023 tax return. So if you're going to file in April, we've got April 15th coming up right around the corner, you would have to get a hold of us right away. But if you plan on extending, then you have a little more time. You have until October to get the study done. We'll provide your tax preparer the numbers, and you can take those deductions on your 2023 tax return. Gina asked a question. If I buy investment property, get evaluated before, fix it up, and then do a 1031 exchange, do I have penalties or have to have a hold period of time? So 1031 exchanges work well with cost segregation. So when you 1031 exchange, you defer all your capital gains tax, you defer all your recapture tax, and you don't have to pay that until you pull the money out of the exchange. So if you're 1031 exchanging into a new property, you just defer all taxes. Now, the downside of doing a 1031 exchange is that when you buy your new property, your basis or your depreciable basis in that new property is lower because you're deferring your taxes and you're deferring your depreciation. So think about it this way. If I have a property that I'm selling for $400,000 and I'm going to 1031 exchange into a property for $800,000, that $400,000 that I'm bringing over in the exchange, I've already taken some depreciation on this $400,000, and so I have to pull that depreciation out of my new building, which means you start with lower basis. And so depending on how high or how much you're increasing the value of your building when you're exchanging, it may or may not make sense on the second property to do cost segregation. And that's something that we'll always look at. I haven't mentioned this yet, but we always do a free analysis on your real estate before we ever engage a client to do a study. So in some instances, if you are going to 1031 exchange, it actually makes sense to not do the cost segregation on the property you're relinquishing or the property you're selling, but to in fact do it on the new property. And so we'll look at that analysis to determine where it makes the most sense. But yes, it does work well with 1031 exchanges. Oh yeah, Don answered that question. Is there any penalty if you still sell too soon? We're going to talk about that here. I think my colleague Rhett might have answered that. Is it too late to do for a property purchased in 2020 and put into service in 2021? So Julie asked the question, if I bought a property in 2020 and put it into service in 2021, is it too late to do the cost seg? The answer is no. We can actually go back without having to amend. We're going to talk about that right now, I think on the next slide. What happens if I bought my investment properties in 2021? We talked about that. Perfect. All right, so I think we've either answered all the questions or I'm going to in the next couple slides. So let me continue on here. Catch-up benefits. So this was the question. I think it was Julie that asked this question. If I bought a property in 2020, put it into service in 2021, is it too late for me to do cost segregation? The answer is no. The IRS allows us to do cost segregation on assets that have already been placed in service. So maybe you bought it in 2021 or you bought it in 2017. It's been on your depreciation schedule. It's been on your tax return for a couple of years. You can actually go back, do the cost segregation this year, bring all that missed depreciation forward and drop it on your current tax return without having to amend. It does require an additional form. You'll see at the bottom of this slide here, it says uses form 3115. So there's a 3115 form that needs to be filled out as part of that. One of the nice things is that we actually include that form as part of our study. A lot of cost seg companies will charge extra for that, anywhere from $500 up to $1,000 extra. It's an ugly 9-page form that no tax preparer, no CPA wants to fill out because they don't do enough of them. So they usually will charge for that. But we include it as part of our study. And on that form, it's interesting. You're actually checking a box that says you're going from an impermissible method of depreciation to a permissible method. So what they're saying there, Julie, is you were depreciating your carpet over the last couple of years. You were depreciating your carpet as a 27.5-year asset. That was incorrect. We're now fixing it, depreciating our carpet over 5 years, And here's the difference in those numbers. And you get to bring all that missed depreciation forward and drop it on your current tax return. So again, if you guys have properties yourself, or maybe your clients have properties, if they meet with their tax preparer and they find out they have a tax liability this year and they've owned properties, now is a great time for us to run our analysis to look at those properties and say, hey, you may not even have realized you had all this deduction sitting here on your taxes, on your depreciation schedule. Let's run some numbers. Let's see how much each of your properties can generate in the term of deductions. And you may be able to offset a big portion of that tax liability, even for the 2023 tax year. Because like I said, we just have to have the study done before you file your return. So hopefully I answered those questions. Let's talk now about, there was a couple of questions in the chat about, hey, when I sell an asset, don't I just have to pay this all back? So there's two types of tax you have to pay when you sell an asset. One is called recapture tax. That's recapture on the depreciation you've taken. The other one is your capital gains tax. Now, either of those are calculated based on how much depreciation you've taken. So I'm sitting here telling you to front load or take as much depreciation as you can. And that's the question we get in return is, hey, if I front load all this, that means I have a bigger tax bill when I sell the asset. And the answer is no, not necessarily. So the idea is you're taking your deductions. So if I do a cost seg study and I front load my depreciation, I get that benefit today against my ordinary income rates of, let's call it 35%. If and when I sell that asset, I'm paying back some of it at a lower capital gains rate of 20% or a lower recapture rate of 25% and saving the spread. And I'm not even paying it all back. I'm only paying back some of it. And I think I'll back into an example because I think it makes a little more sense. But let's say I buy a property for $400,000. I sell it for 5 years later for $800,000. So it's doubled in value over those 5 years. When I go settle up with the IRS after I sell that property, they're going to say, hey, you told me everything's doubled in value, and we're going to charge you tax on that $400,000 of gain, right? Everything's doubled in value. Well, my land is maybe doubled in value. My walls have doubled in value, but certainly my dirty, nasty carpet that's 5 years old is not worth double what I paid for it, right? Carpet doesn't go up in value. Carpet goes down in value. But when I don't have my carpet broken out and I just have everything as one lump sum on my depreciation schedule, just says building, I can't break my carpet out of that transaction. I can't allocate my sales price to the right buckets. I can't say my land and my walls went up, but my carpet went down because I just have everything in one bucket that says building. So I just have to say, hey, my building went up by $400,000. The IRS charges me tax on that. Well, if you remember from the previous slides, what is my carpet worth after owning it for 5 years? What's the book value? If you guys remember, carpet is a 5-year asset. So my book value after owning that carpet for 5 years is 0. So why am I telling the government that it's doubled in value and paying tax on it? I should be paying 0 tax on my carpet. But again, because I don't have it broken out, I'm not able to allocate my sales price to the right buckets, which means I actually pay too much in tax. So if you remember anything from this, this is probably the most complicated thing we'll talk about today, but if you remember anything from this slide here, don't sell your dirty, nasty car more than you bought it for. And then call us, call Don, call myself, and we'll help walk you and your tax preparer through this. But again, the idea is take your deduction against your ordinary income rate, pay back a portion of it. Now that portion is dependent upon how long you own it. Pay back a portion of it at a lower rate at a future date and save the spread. So looks like we've got a couple questions here. Will we receive the recording? It looks like if you are on Team GoGo, you're able to find the recording. So someone asked if they're going to receive a recording. It looks like if you're on Team GoGo, they'll post it there under webinars. Is there a penalty if you pay too soon? We answered that. No, there's not a penalty. You do have to pay some of it back. But again, there's a rate arbitrage where you're taking your deduction at a high rate, paying back a portion of it at a lower rate, future date, and saving that spread. And so we just want to make sure that that rate arbitrage or that spread is going to be more than what your fee is to do the study. And so we'll run that analysis if you've got a property that you think might qualify. All right, so now let's talk, we just got a few minutes left. Let's touch on partial asset dispositions. Partial asset dispositions is one of the added benefits of doing cost segregation, especially if you're doing improvements, because partial asset dispositions is the ability to take a portion of your building or a line item of your building off the depreciation schedule, dispose of it or expense it when you retire that piece of equipment or that piece of building, and write it off as an expense and pay no recapture tax. So let me give you an example, because I don't know that I said that very eloquently. Let me give you an example. You buy a building, you pay $400,000 for it. 2 years later, you have to spend $40,000 on the roof because it needs a new roof. When you put the new roof on, you should be disposing of the old roof, whatever the value of the old roof is, dispose of it in the current tax year, write it off as an expense, and pay no recapture tax. The problem is that on your depreciation schedule, if you don't do a cost seg study, your depreciation schedule just says building 400,000. You don't know the value of the old roof, so when you dispose of that old roof, you can't pull that off the depreciation schedule and expense it. So what we see often, we see way too often, which we shouldn't see, is it says building 400,000, and then underneath that, there's another line item that says roof 40,000 with different in-service dates, meaning they had to put a new roof on 2 years later. Well, now we're depreciating two roofs at the same time. And when you depreciate two roofs at the same time, you're unintentionally, artificially inflating the amount of recapture tax you have to pay because you're taking too much depreciation. You're taking depreciation on your old roof that's stuck in this line that says building, and you're taking depreciation on the new roof. When you do a cost seg study, instead of saying building on the depreciation schedule, it says windows, roof, appliances. You go find that roof line, you pull whatever the remaining book value is off that roof line, expense it in the current year, and then put the new roof on. So now we're only depreciating one roof at a time. So again, this can be done without a cost segregation study. You don't necessarily have to have a cost segregation study. There's ways to determine the value of different components of your building, but it just makes it way easier when you have everything line itemed. As you dispose of the cabinets, as you put new cabinets in your units, you pull the old cabinets off, dispose of it, expense it in the current year, put the new cabinets on, and start depreciating the new cabinets. When you get a new roof, you do the same thing with the roof. So it just makes it a lot easier when you've had a cost segregation study. Let's see. We've got just a couple questions left, or a couple minutes left, excuse me. We've got a couple slides left. Some things to consider on cost segregation. What types of properties are worth looking at? So typically it's any revenue generating property. Unfortunately, we can't do cost segregation on our primary residence, but any revenue generating property with a depreciable basis of about $200,000 or greater. Now remember, depreciable basis is your purchase price minus land value. So any properties with a basis of $200,000 or greater are worth us running some initial numbers. Now that doesn't always mean it's going to make sense. There's different factors we've got to look at, other deductions you may have, your income, is it passive, is it active? There's other things we need to look at, but at least have us run some numbers on any of your assets that are $200,000 or greater in depreciable basis. When does it make sense to do a cost seg study? If you own real estate and you're paying taxes, let us run some numbers and we'll see if it makes sense. But I would always recommend getting the numbers run. If I'm a real estate professional, how do I tell if my client can benefit from a study? So the first thing you want to find out is, one, have they done cost segregation yet? Two, do they have a tax liability? Three, I would get the numbers run. So if they've got a tax liability, if they own real estate, get the numbers run. If that real estate's over $200,000, I would get the numbers run. What items do I need to provide for a cost segregation study benefit analysis? So if you bought the property in the current tax year, we just need a copy of the closing statement. So again, if you bought a property in 2023, you haven't filed your 2023 tax returns, we just need a copy of your closing statement, and we'll run some numbers. We'll pull up some county records, take a look at it on Google Earth, and we'll be able to give you a pretty good estimate on what kind of tax savings we can look for. If you've owned the property for a couple years, so you bought it, like in Julie's example, in 2021, we would just need a copy of your depreciation schedule, which can oftentimes be found in your most current tax return. That depreciation schedule will tell us how much depreciation you've taken on that asset. It'll tell us the year that it went into service. It'll tell us the depreciable basis. And from there, we can give you an idea of how much we can bring forward and drop in the current tax year. So that kind of answers that question there. So either a closing statement or a depreciation schedule is what we're looking for so that we can run our analysis. We've got just a few minutes left here. I'm going to look at the chat. It looks like a couple more questions came in. My CPA had me do a DIY cost seg. Any feedback? That's a great question. So I think it's Stacia asked the question. My CPA had me do a DIY, a do-it-yourself cost seg. Any feedback? That's a great segue. You guys are lining up your questions great. I'm going to talk about the audit guide here in a second. So there's definitely a time and a place for the do-it-yourself cost seg studies. I'll talk about the pros and cons of doing it that way. Does it typically make sense to convert a primary home into a rental? The cons would be increased property taxes and insurance. So yes, there are some pros to turning in your primary residence into a rental, but there's also some cons, as you mentioned. So you don't ever want to do anything in real estate simply for the cost segregation benefits. You'd have to look at, cash flow, and you also would have to find another place to live. There's a number of things you want to look at, but we oftentimes will do cost segregation on assets that were an investor's primary home. They've now converted it into a rental, and we can go ahead and do the cost seg on it. So there's definitely opportunities there, but you want to look at all the different factors when doing that. So to get back to Stacia's question, so let's talk a little bit about the audit guide. So the IRS issues an audit guide that tells their agents how to review these cost segregation studies in the event of an audit. So now I don't want to scare anybody. There's not a great chance of an audit. Like I said earlier, we've done about 25,000 studies. We've been involved in just over 24 audits. A cost segregation study in and of itself is not going to create an audit or trigger an audit. However, if there is an audit on your return and they see that you have done a cost segregation study, they will ask to see a copy of the report. So in the IRS audit guide, they give their agents what to look for in these studies. So, like I said, I wouldn't worry too much about an audit because it doesn't happen that often. But when it does happen, you want to make sure you have a quality study to be able to back it up and make sure that your study follows the audit guide that the IRS has put forth. So getting back to Stacia's question, here are the preferred methods of doing cost segregation. So this is probably my favorite slide of the presentation because I think it illustrates the IRS to a T, but these are the preferred methods straight from the audit guide. Number one, a detailed engineering approach from actual cost. So this would be, I build a new building, I use it as a rental, I've got all my costs from the construction, I do a cost segregation study from those actual costs. Number two is a detailed engineering cost estimate approach. So this would be where you have an engineering firm come in, do a cost segregation study. I bought the building, the building was built in 1970, I bought it today. We don't know the value of all the different components, so we have to use an estimating approach to come up with those values. I want you to go down to number 6, which is the rule of thumb approach. It says an examiner should view this approach with caution since it lacks sufficient documentation to support the allocation of project costs. So this is a smart group here. My question is number 6 a preferred method or not? It's on the list of preferred methods that the IRS puts out, but then they go contradict themselves in the same sentence and say, don't do it this way because it lacks sufficient documentation. So I'll give you a quick story. Work with a CPA. His name's Chris. Chris calls me and says, Erik, my client's done a casual cost segregation study. I said, Chris, I've been doing this for 7 years now. I've never heard the term casual cost segregation study. What are you talking about? This was a client that Chris had inherited. So he goes, let me send you the depreciation schedule and I'll think it'll make sense. So he sends me the depreciation schedule, and on the schedule, this was, I believe it was an 8-unit apartment building. On the schedule, it said building $1 million, parking lot, 80,000, appliances, 20,000, and flooring, I think was the other one for like 12,000. So it had these 3 or 4 line items, all with perfect whole numbers. First of all, if you're going to do that, don't use whole numbers. It's like a red flag to the IRS. Should say like parking lot, $88,742, but they just said 80,000. But what the CPA, the prior CPA had done is they knew that the parking lot was a short-term asset. So they just did a rule of thumb. They said, well, conservatively, that parking lot's got to be worth at least 80,000. So let's put 80,000 on the depreciation schedule. Well, two problems with this. One is if it ever gets audited, the IRS agent's going to say, excuse me, CPA, how did you get to that $80,000? Is that 4-inch asphalt or 6-inch asphalt? And you better have a methodology of how you determine the value of that parking lot in order for it to stand up in an audit. That's the first thing. The second thing is, in this specific example, that parking lot was actually worth about $120,000 of depreciation or $120,000 cost. The CPA was very conservative and said 80,000. So had the client paid for an actual study, we would have determined that that's $120,000 worth of parking lot. That additional $40,000 of depreciation that they missed out on, take that times a 30% tax bracket, that's a $12,000 difference in your tax savings. And a study on this property might have cost $3,000 or $4,000. So again, rule of thumb studies, typically one, you're short-sighting yourself because you're being super conservative, and two, you're setting yourself up for it to be thrown out in the rare case of an audit. Now, Stacey's question was specific to do-it-yourself cost seg, which I feel like fall into this number 6 category for a couple of reasons. One, typically on a do-it-yourself cost seg study, there's no site visit. Site visit is one of the 13 elements in a quality report that the IRS puts forth. Nobody's coming out and actually looking at your property in most cases. Those do-it-yourself costs, that you're basically filling out a questionnaire, you're doing the site visit yourself saying, hey, is there carpet in your building? Hey, do you have a washer and dryer? And the IRS frowns upon that because if you know what you're doing, you're going to be super aggressive when you're answering the questionnaire and no third party is actually coming out and documenting it, number one. Number two, the way that the do-it-yourself cost seg or these online software, they're kind of like the TurboTax of our industry. The way they're able to get away with it is they're using a modeling approach that's super conservative. So they're not actually coming out and measuring how much carpet is in your building. They're just saying that, well, yes, there's carpet, and on average, carpet costs this amount, and so that's the amount they're giving you. So I've seen the do-it-yourself cost seg studies come back anywhere between 12% segregation and 18% segregation. Where if you recall, we usually segregate around 30%. So if you're doing this on a decent sized asset, let's call it a $300,000 asset, if there's a difference between 10% segregation on a $300,000 asset, that's $30,000 of additional deduction. Again, if you're in a 30% tax bracket times 30% tax bracket times $30,000 of additional deduction, that's a $9,000 or $10,000 difference in your tax savings. And so what I found, or what I would recommend, is if you have an asset over about $200,000 of depreciable basis, you're going to benefit by paying for an engineering-based study because you're going to get a larger tax benefit. If it's under $200,000, then it might make sense to do a do-it-yourself cost seg because the fees are typically lower. And again, the benefit's lower, but the fees are lower. So it's just a math equation. You want to weigh out the benefit versus the fees and make sure that you're coming out ahead. So that was a long answer to your question, but that was a great question. Again, I always look at the software ones, the do-it-yourself. They're kind of the TurboTax of our industry. It works fine for a really small property. Just like TurboTax works fine if you're not a complicated investor and you just have one W-2, TurboTax works great. But as you start to build your portfolio, as you start to become more complex, you start to build more properties, it definitely usually makes sense to do cost segregation using an engineering-based method. So any other questions on that? Looks like, I don't think we've got any other questions in the chat. So with that, I think that puts us almost to the end. Oh, one last slide here. These are the principal elements of a quality report. I want to highlight number 3 here. This is that schedule of assets. So one of the nice things about our report is we provide a revised depreciation schedule or a schedule of assets, especially on those look-back studies where you've owned the property in a prior year. We actually calculate how much depreciation you could have taken versus how much depreciation you took, and we come up with that number for you and your tax preparer. Now, I would say very few in our industry will go to that length, but with this new audit guide that was released at the end of 2022, the IRS is actually stating number 3 there, when a taxpayer reallocates the cost of assets already on the books, a quality report identifies those assets impacted and provides both records from before and after. So again, I think the IRS, they're trying to standardize our industry. It's kind of been the wild, wild west for a number of years. With bonus depreciation, cost segregation is becoming more and more popular. And so I think they're trying to just kind of standardize it by putting some of these rules and regulations in place, which I think is great for the industry. But you just always want to be careful about who's doing your cost seg and making sure you have a quality company doing it so that you can stand up in an audit, number 1. Number 2, you want to make sure you're maximizing your benefits. So with that, I will go ahead and turn the time over to Don. Please use this as a resource, you guys. If you ever have any questions around cost segregation, around depreciation, our contact information is there. That QR code will get you over to us as well, but please use this as a resource. I think the weirdest question we've ever been asked is how to depreciate deer at a breeding facility in Wisconsin. Honestly, I didn't know the answer to that question. I had to get with our tax preparers here, our CPAs, and get the answer, but we were able to get the answer for the client. So we're a niche accounting firm. We don't do tax returns here, so don't call me and ask me about earned business income or child tax credits. I don't know anything about that stuff. But if it's depreciation related or real estate tax related, we can usually get you an answer. So again, please use this as a resource, you guys. If you have buildings or if your clients have buildings that you think might qualify or you want to have us run the analysis, that QR code will take you to a page where you can input your information, allows you to send it to us directly. We'll run the analysis and we'll let you know what our fee would be. We'll let you know what the expected tax savings would be. And also, if you use that code, we are offering a 5% discount for GoGo and her clients. So with that, Don, I think I've answered everything. Let me just double check the chat. Oh, someone put that in there, put the code in there or the landing page. So with that, Don, I'll go ahead and turn the time over to you.
Yes, thank you, Erik, so much for your presentation. It's always so much fun to listen to you. I always love your stories. And as Erik mentioned, guys, feel free to use that QR code or the link that Lindsay put in the chat. I will be happy to run that free benefit analysis for you or answer any of your cost segregation questions that you have. All right, Lindsay, anything else?
I think you guys did amazing. Thank you so much for your time, for being here. And also thank you so much for being our guests. Guys, they will be with us again, the Go Get 'Em webinars next month, April 16th. We're excited about that. If you're a go-getter, you can have another training with them. And yes, I think that's it. Thank you so much for everybody for joining us today.
Thank you, Lindsay.
Yes,
for
thanks
having us.
everyone.
Take care.
Yeah. Take care. Bye-bye, guys.
Thank you. Bye-bye.